Almost ready. All right, I think we're ready to go. I have to figure out the music, though. Found it. All right. Guten Morgen. Hey, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Because trading is risky, not appropriate for everyone, your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Hi. Hey, I want to answer Ojo's question. Ojo. Okay. The central pivot, is it important to bulls or is it important to bears? In a trend, in an uptrend, what's more important, the M2 or the central? That's what we're asking. Well, let's start with it. Who is the central pivot important to? Yeah, but in a bearish market, who's it important to? Okay, because remember, someone else, if you're a bull, someone else is a bear. Ojo, is a central pivot point important to a bear? Yes or no? Ojo. Ojo. Or is the J like an H? Is it Oho? There we go. Okay, good. Yes, it's important to both bulls and bears. If you think it's important as a bull, a bear thinks it's important being bearish. So therefore, I don't really care about the central pivot point. Okay, I don't really care. So bulls buy higher lows, M2. Bears sell lower highs, M3. And as Jim rightly points out, it's the pivots themselves are not that important. It's the zone between, if you're a bull, between the central pivot point and the M2. In that zone, I'm looking to buy. Okay. But like the central, yeah, you can, but it's just the first part of the zone. But I don't care about the central pivot really. Okay. Okay. Remember, I don't buy prices. I buy change in direction at prices. So if it came down to the central pivot point, listen to what I just said. If it came down to the central pivot point, and I'm a bull, and it hit the central pivot, or anything near the central pivot, and then I get a 5A cross up, I can take it. I can take it long. But it's the zone. So I would never argue over a price. I'm buying a dip, I'm a bull. Okay, that's that. M2, yeah, great price. Central pivot, okay, that's pretty aggressive. Okay. So M2 is the answer to your question. All right, so quickly, guys, we have GDP coming out in shortly. Okay. Resources associated with my work. Investor Bootcamp will teach you how to trade properly. Proper techniques, proper thought process, fundamentals, technicals, trader psychology. Okay? It's all there. It's awesome. It's cool. I've been building these resources for 20 years. It's good. QuantBox automates your fundamental analysis. So think of it as a virtual quantitative analyst working for you. Tradars is a virtual technical analyst that will work for you. Combine it all together, training, coaching, fundamental analysis, technical analysis, you're going to be a force to be reckoned with. You're going to need a good trading partner to execute your trades, a service provider. You want to have a world-class business? Well, you need world-class service providers. I recommend Trader's Way. I recommend you use an ECN. Most Forex brokers are not ECNs. And if you don't know the difference, just trust me, bro. Then do some research, find an ECN. I recommend Trader's Way. Go check them out. Do your own due diligence. And we're going to use today tradars to analyze GDP. In particular, patterns produced by the results of GDP news events. So have you answered the poll? I need a few more votes before we get a statistically relevant result. Please answer the poll. Do you think GDP results will be greater than 2.5, less than 2.5? Okay. Wait, I think I put my little thing back. Just greater or less. I think I copied and pasted wrong, right? I think that right. If the actual is less than 2.5. Yeah, I got that right. If the actual was greater. Yeah, I got that right. All right, here we go. Last chance. 3, 3, 3, 3. 2, 2, 2, 2. 1, 1, 1, 1. Kick busted. Doom, doo, doo, doom, doo, doom, doo, doom. Can't move this. All right, let's see. All right, thank you for your participation. You think GDP is going to come in hot. Actual is going to be greater than. If you're trading euro dollar, there's a 2-hour, 4-hour, 12-hour pattern. So a scalp day trade type scenario. Short term, 71.4% chance of down. Medium term, 100% chance. Nice. Okay. You good with euro dollar? What would you like to trade? Let's do another poll. Let's do a poll. Okay. If we'll just say how about this? How do you want to trade GDP news? Question. It's really what asset class? Euro dollar, Great British Pound dollar. Add option. We'll do USD yen. And we will do USD CAD. Oops, come on now. Okay. All right. What do you want to do? Talk to me, Goose. Okay. Look at the results. Okay, look at the results. Don't just do what you like. Don't do what you always do. Don't do what you're habitually doing. Don't be a habitual trader. Well, to analyze setups, you're a customer, but you're right. Jay, but I'm asking you to look at the data, you're a customer. It's a data question, yeah. But you're right. In general, you're going to buy dollar or sell dollar, right? JP's making a decision, and JP is looking at the statistics and the time frames that produce patterns. Sure, but that's not what the question is, you're a customer. You're being a smarty pants, but you would get a bad grade in university. You have to answer the question. Of this data set, looking at results of patterns related to the outcome of the news event over years, which one is the best to trade? If I gave you this data, make a decision. You know what I mean? Okay. So think of it this way, and I'm picking on you a little bit, your customer. I don't mean anything, right? I don't mean anything by it. We're making a lesson out of it, right? We're making education out of this, right? So we are trying to break our habits. Okay? And we're trying to improve. We're trying to refine. We're trying to adjust how and why, let's say, we place our trades with the hopeful outcome of improvement, okay? And so with this known data set, not what you usually do, but with the data, how can you use data to improve your results? And so now we have the data. So we'll look through this. Okay, Aussie dollar has 1, 2, 3, 4 time frames, all in one direction. Interesting. Euro, 1, 2, 3 time frames. Okay, maybe not as good, but acceptable. Pound only has 1. And then there's no short-term discernible pattern. Now, will pound dollar move? Will it have volatility? Yes, but without a reliable pattern. I mean, think about this. If you only traded reliable patterns, would your consistency improve? Can you guys answer that? I know it's a rhetorical question, but it's psychological. If you only traded reliable patterns, would your trading consistency improve? Yes or no? Okay. So we're trying to bring that consistency. That's all. So there's no consistency short term on the pound dollar. You could make money trading the pound dollar, I'm sure of it, but not reliably. Now, you might just be doing a vol trade or doing whatever type of trade. That's good. It's tradable, but you just are doing it without a reliable pattern. Kiwi dollar, no scalp, not even really a day trade. There's only kind of a swing trade in there. USD CAD, again, no scalp, no day trade. So this just kind of goes in the general trend, but you could probably pick this trade up with a 71.4% accuracy tomorrow. USD Swiss franc, 2 hour, 4 hour, 12 hour, 48 hour, all okay. Good. So we got a scalp, a spot, a swing, a position. And USD yen, yeah, it's okay. So statistically, and then you look at the percentages, are they quite reliable? Yeah. So I would say, well, let's see what you said. Euro dollar, and that is not the best answer. Now you might say, well, because of the 4 hour. Well, but you still have a better spread over time. So 2, 4, 12, 48. 2, 4, 12, but no 48. 2, 4, 12, 48. So there's just more reliability in an Aussie dollar and USD Swiss franc. Okay? You see? You'll end up getting similar results, but there's just statistically a little bit more reliability over the course of time. So you could trade euro dollar and you'll probably be fine. It's a scalp day trade scenario. And it'll probably follow through. And maybe you preferred it because it had 100%. Yeah, well, whatever. Yeah, but you know, okay. But really, I think the better answer is like USD Swiss franc or Aussie dollar. Now, another way to then filter this further is if you're already, let's say if you're already a bear on euro, you would sell it. If you're already a bear on Aussie dollar, you would pick this one. If you were already a bear on Swiss franc, you would pick this one. Okay, now Denise says, I like the probability of 100%. Okay, that's fine. You're making the decision, right? But there's a little more volatility inside of that. But you're fine. I guess another thing I want to point out is I'm also trying to show you, like, don't get hung up like there's a 100% chance I'm going to make money. No. In the past, on the 4 hour, you know, looking over the last several of these events, it always produced down, but it doesn't necessarily mean in the future. Like it's not really probability, it's past performance, and it's not predicting future results. So it's not like, you're right. So I would say this is good, but it's not any better than these things at 85 or 86, right? We're seeing like the consistency of direction, but what I would prefer is the consistency direction on all time frames. Somewhere in there, right, Tradars is saying, well, this works for a day, but then collapses for some reason. Also, I'm not sure if I'm terribly bearish on euro right now, but I am bearish on Swiss franc. So I think I'd do Swiss franc because the Swiss National Bank is cutting interest rates. Okay. but maybe today is risk off, you know? So, yeah, so anyways, it's the thought process, okay? I'm just trying to break habitual habits as traders where, you know, and I should get rid of this just in case. Let me get rid of that order. Right, I'm trying to break the habitualness of what we do. We're very habitual being traders, and sometimes we become superstitious and all that kind of stuff. Like I never trade CAD. You know, that's silly. Right? So anyways, I'm trying to get, there we go. I'm trying to get like a logical, quantitative process to the decision making, and not just trade euro dollar on the GDP, because you always trade euro dollar. Okay? Now it might work, but I don't want you to trade that way, because it's not, on the long run, not proper. You could be trading euro dollar 6 months from now on GDP, and it may not be the right thing to trade, or a year from now, or, you know, 2 years ago, maybe it was right, but now it's not right. So, you know, break the habitual part and trade what makes sense if you have the data. Well, now you'd have the data. In the past, you didn't have the data. All right, so we're waiting for our year-over-year number. Is it going to be greater than 2.5? Okay, wait for it. Wait for it. Wait for it. Numbers are coming out. Initial jobless claims 213. Wait for it. Well, that's the average. 207 is the headline initial jobless claims. Trade balance negative 92B. That's okay. 1.6. Oh my God, it's horrible. Oh my God, it's horrible. 1.6. 1.6 bloodbath. Oh my God, bloodbath. Bloodbath. Help me. Help me, Oprah. Oh my God. So we got to look at the less than, and that's USD Swiss franc the other way. Boo. Let's go here. Oh, it's terrible. Huh? What do you think? Fed's going to cut now? Of course, I don't even have it over here. How funny is that? Do you have the time to listen to me whine? Ugh, look at that. Just a beast. So that... In fact, I think on this one, euro dollar might actually be a better one as well. But anyways, don't forget things like, since we were talking about them earlier, don't forget about things like pivots and stuff. Remember, you're trying to identify support and resistance. Right? Do all this. Bum, ba, 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 ba. Ba, 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 ba. And I want to actually, I'm okay, like maybe a euro dollar on this, or even a pound dollar. You know what? Let's do pig. Am I allowed to do pig? I'm not allowed to do pig based on our analysis. I want to do it anyways. Mm, uh, yeah, this is the one I want. Look at the round trip on that, huh? Man, oh man. That. Bum, 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 ba-dum-dum. Okay, so now some logic here. It's bad, so it's risk off, but maybe it allows the Fed to cut. What do you think about that thought? Okay, what are your thoughts on that? Okay, so we go out here and we see what's happened in the past. Remember, this is not predicting what's going to happen. Quantbox doesn't know what's going to happen. 2, 4, 12, 8. So we only know what has happened. And you say, show us. Okay, in these situations, the news came out. Well, the strategy is this way. The news came out, settled down, but closed higher. Okay, popped, dropped, closed higher, dropped, closed higher, dropped, closed higher. Okay, you see? So, right, look at the difference though, just crazy. 2.5, the actual is 1.6, negative differential. Okay. We can draw the following conclusions about the expected movement of euro dollar based on the last 12 GDP growth rate quarter over quarter advanced events in the United States. 80% chance that the 2-hour trend is up. 2 hours. 2 hours. Not 2 minutes, 2 hours. With a follow through on the 4-hour, the 12-hour, and the 8-hour. So let's look at the day trade. Okay. At the day trades, this is a little bit longer. Closed, in fact, flat, but higher. Kind of flattish, but higher. But look at it. It did vol up and then hesitate. Okay. This one had a greater differential, and it produced much stronger. But notice down for the first hour almost an hour and a half, and then up. Okay, so it, in this case, waited for the stock market to open, waited for the stock market to open, waited for the stock market to open. This one you should have earlier profit taking. This one took off straight up. Okay. Now, what about if we do this like I said, or how about what did USD Swiss franc do over 12 hours? It popped and dropped, closed lower. It dropped and dropped and closed lower. Dropped and dropped, closed lower. Okay? It popped and dropped and closed lower. This one dropped and closed lower. So what do you think? You might say, well, I like this USD Swiss franc better. Okay? Cool. Well, then switch over. So this is an interesting buy price, right? Going back over to that Swissy. The only thing is I typically don't like if I was risk off, I'm buying both of these, right? So that's why like the pattern exists though. Okay. Yeah, and that's what Big Perm is saying too, right? Can I explain risk on or risk off? Sure. Can I explain it quantitatively? Yeah. Do you have the time to listen to me whine about everything and nothing at all? It was GDP, Kevin, not CPI. All right. What is risk off? Okay, the assets that we trade are correlated. And in certain market conditions, investors favor, for whatever reason, to buy certain assets or sell certain assets. Now, usually you accumulate something and you're like, instead of having cash, I'd like the asset. And then other times you're like, I don't want the asset, I prefer cash. Okay? So if you don't like cash, you're willing to take some risk because you think you can earn more, right? More money than what your money earns. So if you buy the stock market because you think it's going to go up 10%, but if you save your money and you only make 2%, you're like, well, there's a differential of 8%, but I have to assume some risk. There's a risk premium. So you're like, I'm going to assume some risk and buy the stock market. So if you're doing that, that's risk on. You're selling cash and buying risk. And you expect, which is expectations, right? You expect a higher return. And then you look at how these assets perform in these risk on or risk off markets. And we call that correlation. And you want to look for correlation on these assets to discern how do market participants feel about the market. So the assets we look at are the Japanese yen, the US dollar, the stock market, gold, the bond market, and volatility in the market, in the stock market particular. Okay? And we look at it on a daily basis, a weekly basis, and a monthly basis to have multiple time frames. So, who asked the question? Alex. So, Alex, let's start with the basics. Okay? Month over month, the yen has lost value. That's good. Why? I know when the yen loses value that the stock market is going up on that time frame. Doesn't mean it's going up today or yesterday or in the next 2 hours. But when the Japanese yen weakens, the stock market is usually bullish. Why? Well, first of all, that's my experience. But second of all, the Japanese yen is used as leverage by investors. So you take on some Japanese yen, and then you sell the Japanese yen to buy an asset. We call that a carry trade. So when the market is heavily selling Japanese yen, they're usually taking on risk somewhere else, and it's an indication of risk on. They're just simply using the Japanese yen because it's the cheapest, okay, and then buy something else with it. So that's bullish. That's good. The dollar is strong. That's bad. The S&P 500, okay, is down month over month, almost 3%. Well, that can't be good. The people are losing money. The 50% of America have retirement accounts invested in the S&P 500. So that's not good for anybody. Okay, gold is going up, and I score that negative because I believe they're buying gold because they think their cash is trash. Why is the cash trash? Well, inflation Inflation diminishes the value of cash. So they're like, well, I'd rather store my value in gold. Well, that's not a good situation. Gold might be going up and you're making money on gold, but you're losing money in cash somewhere else, and that's just bad. Okay? Yields in the bond market, in the treasury market, are going up almost 9% month over month. That's the cost of doing business in America going up and up and up, which makes every company in America less profitable. Or it makes your mortgage payment go up, which makes every citizen in America that owns a house, more expensive. So, right? Well, we're not on variable, but the idea of, can you buy a house if interest rates are going up? No. Well, these are yields, but they're similar, right? So it's bad. There's nothing good about it, Alex. And then volatility is up. That's bad. Volatility is bad. So there's a 20% or 19% increase month over month as of right now. This could have been higher, lower, earlier, but right now, month over month, there's a 19% increase in professional institutional investors hedging. That's all VIX really is. They're using options to hedge their S&P 500 position. So the S&P 500 is down 3% month over month, but hedging is increased by almost 20%. Oh my God, there's fear in the market. That is not good. Add it all up, and we have risk off. Investors don't feel like taking risks. Investors feel like protecting their money. That's why they're buying insurance on their S&P 500, and their S&P 500 is losing money. Oh my God, it's bad. Okay? Bad, 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 bad. That's risk off. But that's month over month. Week over week, we have a little bit different numbers. And so that's where you want to look at short-term versus long-term. On more of the short run, yen is flat, no big deal. Dollar's flat, no big deal. S&P 500's up a little bit. Well, week over week. Well, I guess that's good. But of course, you probably know it dropped 6% last week, and now it's up 1% this week. Is it really that good? Okay? So net, we're really down 5%, right? So maybe later today or tomorrow, this starts to roll over to risk off again, which we're already here. So if you get congruency on multiple time frames, then what do you have? An intrinsic underlying trend by analyzing 6 different types of traders in the market, actually 6 different markets, and showing based on the relationship of these assets, how these institutional investors, or I suppose it doesn't even matter, it could be retail traders too, how the market feels. Do they feel like taking risk? Risk on. Or are they reducing their risk? Risk off. So typically with this monthly evaluation, if weekly turns to risk off and monthly is already risk off, you're probably going to buy the dollar, the yen, and the Swiss franc, or at least pull up those markets and look, because we know, we know these relationships. So if the dollar's strong, the S&P 500 is probably falling. If the dollar is strong, euro is probably falling, or Aussie, for example. And how do we know that? Well, that's the relationship. Risk off. They're going back to cash. Why would you want to own cash? Okay? Why would you want to own cash? Because you can't eat you can't eat your financial asset. You can't eat your house if your children are hungry. And they're worried. If you were worried about that asset losing money, you'd want to sell it at the top of the market and convert it to cash. That's all. Whatever. You can't eat your stock. So you bought a bunch of Apple stock. And now you're worried about the stock market crashing because our GDP just dropped by 50% in a quarter. And you're like, oh my God, productivity is horrible. Okay, you could say, well, maybe you want to lighten your exposure to the stock market by selling some of your stock at profit. So now you have some cash to feed your children. Okay? You're like, I'd rather own cash than Meta stock. I'd rather own cash than own Tesla stock. Well, you're worried about the value of those assets falling. So you're like, give me my cash. Give me my money. That's risk off. I don't want the risk. Just give me my money. I want out. Give me my money. Just imagine you're selling everything. I want out. I want out. Okay? You don't like the risk. So that's the risk on or risk off. But I don't make a guess on this stuff. Okay? We were mixed across the board or neutral across the board for almost 5 weeks. 5 weeks. And you know what? The markets generally didn't do anything. And I'm certain the average retail trader just did what they always did, or they did what worked 3 months ago or 3 months before. And now they're there in this period where it's not working now, and they don't know why. They're not making money. They're losing money, and they don't know why. They're like, well, I made money for the last 3 months, and now I'm losing money. So maybe I got to change my trading strategy. Maybe I got to do Elliott Wave, or maybe I need to scalp more, or maybe I need to have smaller stops, or maybe I need to have bigger stops. And what you're doing is you're changing all your tactics, but you have a piss poor strategy. Trust me, a piss poor strategy never leads to consistent consistent desirable results. It adds to consistent results, but they're negative. Okay, you need good strategy. Okay, you need good strategy first and foremost, not just amazing tactics. You have to have good strategy first and yeah, you see? That's why you are here. Cool. Join FX Bootcamp. Join the swing trading group. That's it. Bootcamp is Investor Bootcamp's $88 a year. The swing trading group is $99 a month. Just start there. You have 100 hours of training. You need to know that. and then see how we apply this stuff. But on Tuesdays, I go through all the fundamentals, report by report by report by report. We actually read the fundamental reports from central banks and governments from all around the world. We literally read the data. And then I talk about it. I explain the stuff that is hidden in the weeds of the language. You'd have to be an economist to know what some of this stuff is. Well, guess what? I'm a classically trained economist. Cool. So it's that kind of stuff. And then today is the swing trading group meets again. And today we're going to do technical analysis for 2 or 3 hours. Okay? It's not bad. That's a lot of technical and fundamental analysis training for $99, right? And I have a big announcement, several big announcements next week. Right? I'm not going to tell you today, but you'll benefit at no extra cost. Okay? Okay. How does WTI respond to raising interest rates? Okay, well, what kind of impact does the market have if borrowing costs are going up? Mr. Monka, if you spent a lot of money on a credit card and interest rates on your credit card went from 20% to 40%, do you spend more or less on your credit card? Logically. $40 credit card. Hell no, Abdul. Are you joking? That makes no sense, Abdul. I think I lost internet, huh? Oh, I think I'm back. I hear my MT4 struggling. Even my laptop in the other room. Well, YouTube says I still have excellent connection, so that's good. Okay. I mean, QuantBox and TradeRs is so ridiculously cheap. They're less than $100 a month each. I mean, my God, I used to spend $300 a month on my charts. The amount of resources you get now is so cheap. So does $88 a year get you QuantBox and TradeRs and everything? No, dude. But it's so cheap. You know? It's so cheap that there's no way it holds you back from your success. But if it does, I can't help you with that anyways. Right? You know? Like if you're like, Wayne, I want to create a multi-million-dollar business and I want to have the same resources as any billion-dollar hedge fund because, you know, this is my trading business. I'm going to build an empire. Well, it's going to cost you $300 a month. Oh, forget it. I'm out. I mean, dude, like, I can't. What you should look at, the way I look at it anyways, and, you know, we're all different. We're all from different places and we have different levels of income and all that kind of stuff. So I don't mean to, like, I'm just saying, being a former high-tech entrepreneur and former venture capitalist. If you said to me, Wayne, I could build a business that could make, let's say, hundreds of thousands of dollars a year. Let's keep it reasonable, right? and your startup costs are $300 a month. I mean, I'd laugh. Like, what the F are you talking about? That's so cheap. It's a rounding error. Like $300 a month, and you're going to make $100,000 a year. I mean, that's it. And then after a few years of that, you're like, wait, I'm going to incorporate and stuff, so I need to set up a company. Well, that's cheap now, right? And you're going to lower your taxes, and then you're going to set up a pension fund and stuff. So now that kind of business, now you can get that going for $5,000. So now you have an incorporated Forex trading business, and you got all these tax write-offs. You've lowered your income. You're writing off the $300 a month in expenses, and I'm like, dude, it's so crazy cheap. This kind of stuff just 20 years ago would have cost you 10 times more than that. At least 10 times. I mean, actually, significantly more than 10 times that. Right? Right? So anyways. Right? So there's just no way these resources that are $1 million resources at less than $100 a month each, there's no way that's holding you back from that. There's just no way. You're like, I want this, but it's too much. There's just no way that can be true. Yeah. Yeah. Hey, no worries, Roderick. My number one goal is eventually to, break even. my goal is always break even. So like I created, by the way, and that reminds me, I created tradeplans.ai, right? And I've lost thousands and 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 thousands of dollars on that. You guys just don't use it. So, and that reminds me, you have a donation on that. Turn that off, please. I appreciate the support, but let's kill it. I'll probably just kill that business because you guys don't use it. A virtual coach, but you guys don't use it. So I'm just burning money keeping that AI alive. Cool. Well, my goal was break even. You don't use it. You don't like it. It doesn't work well for you or something. Okay, great. We'll kill it and we'll move on. So I hope TradeRs gets to break even. I hope QuantBox gets to break even, right? Yeah, I tried to turn it off. For some reason, I can't turn it off. So I apologize. Yeah. But that was very, very cool of you. So yeah, so if we can get break even, great. I'm happy. That's my goal with this stuff. I build it for you. I build it for us because, dude, I want this stuff. So. Okay. Yeah, well, that's cheaper, isn't it? Yeah, the TradeRs email is cheaper. Yeah, for sure. Yeah, you'll use it more in that case, But too bad. I love the idea of a virtual assistant. Just love a virtual coach. Okay, cool. All right, so is it kicking in? This is the big question of the day. Is it kicking in? Okay, we don't know the future. Okay, we don't know the future. Okay, but this is the plan. And we had up and then down. We had down and down. We had up and then down. And we had up and then we had down. And then we had down and down. Okay? So there's the thought process. There's the plan. And our response so far was up. Okay, well, we don't know the future. Past performance does not predict future results. This is not a crystal ball. There's not a genie in a bottle. We just know the pattern that this market in this circumstance created in the past. Now, maybe this time is different because, oh, well, this means the Fed will cut. This means the Fed won't cut. This means things are good. This things means they're bad. This means the stock market up. This means the stock market down. Well, we don't know the future of how everybody, all these market participants are going to react. We just know the technical pattern that was produced in the past. That's all. So it's either going to down and down or up and down. Okay? And with that, I got to go. Peace on earth. May the pips be with you. May your profits be above average. Remember, investorbootcamp.com, quantbox.co, tradars.co, tradersway.com. There's a lot of powerful tools out there. You could build essentially a business that has $1 million potential, certainly hundreds of thousands of dollars of potential, and you can get this business up and running for a few $100 a month. Like, it's stupid cheap, but if you throw away this opportunity, well, God help you. So I'll see you soon. Today's Thursday, right? So we have our swing trading group later today, and then tomorrow I'll be at the street, fxstreet.com. Trade safe. Be smart. See you in the swing. investorbootcamp.com. Cheers. That just happened.